Welcome to the Spotlight series. Don't just survive, thrive. Most of us have experienced challenging times, now more than ever. The key is how we choose to respond, whether we merely survive or thrive. My name is Nicola Steele, founder of JJP Talent Solutions, an Australian IT recruitment company. With over 20 years' expertise, I provide insights on how you can transform your career to the next level. However, we are not just our careers. We are spouses, partners, parents, friends, etc., with a variety of needs and wants. In this podcast, I talk to a diverse range of experts from different professions, such as finance, law, psychology, and health, to provide insights on how you can survive and thrive. I don't have all the answers. However, collectively, we can instill hope, clarity, and inspiration. I hope you enjoy listening. I'm pleased to introduce Megan Kelly. Megan is Director of Superannuation at businessDEPOT and has extensive experience advising businesses about their finances. Megan, thank you for joining me on episode 4 of the Spotlight series, Don't Just Survive, Thrive.
Thank you for having me. So as Nicola said, I'm used to advising clients about their businesses. And today we're going to delve into some of the struggles that we've had during business and some of the forward-looking things we're doing for clients. One thing I would like to say right from the start is that everything we talk about today is just general advice, and you really should seek personalised advice from your own advisors, or we're happy to help if you had any questions based on your personal situation. Yeah.
Thank you very much, Megan. And I will share on the show notes about how they can get in contact with either yourself or with BusinessDEPOT. Mm-hmm. So before we get started into the nitty gritty, tell me a bit more about yourself and what you do.
So I've got close to 20 years experience now as an accountant. I'm both an accountant and a financial advisor, and I've specialised in particular in the self-managed super fund space. But BusinessDEPOT ourselves, we're very focused on small to medium-sized businesses. And so our client base is that small to medium business owner. And so a lot of the self-managed super fund clients that I'm looking after are actually also business owners. So I get to do a real niche of work where the super fund interacts with the business for those clients.
Thank you very much. So with all the years experience that you've got of working with business owners on their self-managed super funds, what has been the impact of the current crisis on those and their kind of financial plans?
So having worked in this area for quite a long time, I've been through the GFC, so I saw the impact that has had for these clients. So this is quite a different impact that we're seeing so far on self-managed super funds to the GFC. We're seeing the drop in investment prices for clients, but in particular, that's probably only the immediate impact. We're not seeing too many other issues for a self-managed fund unless they're a property owner. So a self-managed fund with a property where they're landlord, they're the ones that are struggling at the moment because their cash flow, depending on how their tenant's cash flow has gone, has really dropped off a cliff. So they're probably the ones that are struggling the most and are seeing the initial impact. What we're expecting is that as this progresses and as businesses try to recover from the downturn in the economy following the pandemic, is that the super funds will feel that impact more. So they'll start to see their dividends being reduced and having to look to do things to fund their ongoing cash flow in the super fund as their cash reserves start to get used up. So at the moment, they're going quite strong, but we are sort of forward looking. And so is the government. So the government has come back and said to self-managed funds that, well, all super funds that are paying pensions in particular, they're allowed to reduce those minimum pension payments by half during this period. So that's great that that's come through, and that's been a really quick response. That's something they introduced during the GFC as well, and was a really good measure. And basically what that does is it means the fund doesn't have to liquidate assets while they're in a down market to fund minimum pension payments. And that's probably crucial because obviously as soon as you cash out of an asset, those losses of are being crystallized, and you can't regain that growth once the market picks up. So that's a great move by the government that's already happened.
That's great, and thank you very much for that advice there. As you were talking, it got me thinking. So if, for example, you hadn't got a self-managed super fund, and now you presumably would be getting it at quite a cheap price, would now be a good time to invest before the prices go up eventually?
Anyone who's looking, so a self-managed super fund is just a special type of super vehicle, and so anyone looking to invest or has that spare cash available at the moment, yes, there is a bit of a benefit of investing right now. The market is quite volatile though, so it's hard to decide when's a great time. But the prediction is obviously that the market will go back up as time progresses. So if you have the cash, it's certainly a good time, but be prepared to be in it for the long haul, because we don't know how long it's going to take for businesses to recover. And I think the harsh reality is that not all businesses will recover as well. So do your research and be very mindful of what you're investing in, that is a good company and it will come back in terms of share price and growth.
Absolutely. And it's, I guess, it's the uncertainty, whether it's going to be 6, 12 months or 3, 5 years, and whether you can afford to for that money to go down.
Yeah, also at the moment, I think with uncertainty in business, you probably need to be a little bit careful as to how much money you are tying up in investments, because you don't want to tie up money in investments now and then find out in 2 years' time you need that back in your business or your personal cash flow, and still have the market be down. So just taking that into consideration, know what your cash flow projections will need to be for the next couple of years at least.
Yeah, and I was having a similar conversation with Cara Brett last week. It was more around your personal finances. So what advice would you give to businesses about surviving and ultimately thriving in the current market?
Yeah, I think the best advice I can give businesses at the moment is to know your numbers. And I know that sounds very general, but you need to understand what is your absolute break even point as a business. What is going to keep your business ticking on during this time, and how long, how much cash have you got in reserve to help you get through that? We're telling businesses right now, cash is king. Don't go out on spending spree. Look at your cash, look at your cash flow needs, keep it there in reserve. So to do that and to maximize that cash at the moment, we're asking all business owners to review their expenses and to take advantage of the opportunities available during this time. So some of those opportunities, and I know Cara probably talked about this from a personal point of view, is to actually talk to your suppliers in your business as to what they're doing to help customers through this tough time. So some of your suppliers or your insurance companies or other things within your business, make the effort to reach out to them and see what cost savings you can take during this time, because you might not just need that. Even if your business is going well right now, you might feel the knock-on effect as people you're supplying your goods or services to can't pay you as quickly, or some people, their businesses aren't feeling the impact right now, but they will feel the impact when their debtor days start to blow out. So they need to start looking at how they can save some costs now so that they've got cash to keep paying their employees and keep their business moving during that time as cash flow coming in starts to slow down. So that's one. So suppliers, landlords, the other people to talk to is your bank if you need to have some relief from funding on your finances. So their options are to negotiate sort of a repayment-free period or to interest-only periods as well if you're paying P&I. And talking to your finance guys about that if you need to do it. The other thing is to look at what stimulus packages are out there for businesses as well. So there's a few that we might go into a bit more detail of today, but there's also a lot of stimulus packages that are going out there from state by state. So every state government is offering different options. So it is important to reach out, make sure you understand what is available to you in your business and your state as well. Different businesses have different packages available as well, depending on how much they're being impacted. So it's worth knowing those answers for your business.
And I think overall the Australian government do seem to be providing some very good packages for business there. I guess the two main ones would be the cash boost and also the JobKeeper allowance. So it's kind of constantly changing, and I appreciate that. There's a new update almost on an hourly basis. But what can you tell me about on the JobKeeper allowance and also on the cash boost stimulus as well?
Sure. I might start with the cash boost one, as that was the first one released. So that came into, that was announced fairly early on in the situation, and we've had a little bit more clarity. And we've actually seen some of those payments coming through now. So the way the cash flow boost works is it is not cash to your business. You won't necessarily receive a lump sum of cash from the tax office when you lodge this next BAS. But the way they're linking it is they're linking it to your quarterly activity statements or monthly activity statements as you lodge it. So the March one is the first one, and it's available for businesses that are the small to medium-sized businesses and have turnovers under $50 million. And the amount that they get is going to range between a minimum of $20,000 and $100,000, depending on the business's size. So some of our clients for their have already received this in their activity statement account with the tax office. And as they lodge their March BAS, the $10,000 would automatically come off any amount payable on that BAS. So those clients are going to have a reduced quarterly activity statement. So it's not a cash flow boost as such in terms of you don't physically get the cash, but you will have to pay less cash out. So it does still help the business and the business's cash flow. Important things to note is the tax office will only apply that amount against the debt for that quarter. If you are late paying other debts with the tax office, you do need to talk to the tax office about that and enter in some payment arrangements, but they're not going to keep this payment for those. And if $10,000 or the amount that you're receiving from this payment is more than what was due on that BAS, then you can apply for that credit to be refunded to you.
Okay, so for example, you couldn't use it for your company annual tax to pay that off. Does that make sense?
Not unless so it will first go against this quarter's or this activity statement being lodged. If you have money left over once that's done, then you could potentially go and pay other tax office debts or other debts that you've got. But you can actually ask for that money to be refunded back into the business as well.
Okay, thank you. Sorry, my question wasn't terribly clear there.
Okay.
And then the other big one as well, which I think has almost been finalised, is the JobKeeper allowance.
So yes, we've actually the JobKeeper's been released a little while ago, and you could register your interest with the tax office for the JobKeeper, and I think a lot of businesses have already done that. But as of Monday this week, we've actually been able to go ahead and complete the actual application form. And the way the JobKeeper works and is all designed is about keeping employees employed. So the first stimulus package, there was quite a lot for people who had been let go from work, and you're seeing people being supported. And I think what they've realised is a lot of these businesses will come back once lockdown restrictions have been removed. So they want to give those people clarity that they'll still have a job to go to. And that's what the JobKeeper is designed for, is the business can keep on ticking along enough that it'll be back in business post lockdown, and that they will be able to have these employees come back on board. So the JobKeeper one is quite complicated, and it is a bit of a case-by-case basis. But we have clarity on most of the rules around that now. I just had an email through just before we came online around the last measures, which is around some of the alternative tests that they're going to be applying if you don't quite meet the straight eligibility tests. So the eligibility test for the JobKeeper is that you had to have employees of 1 March 2020. So if you happen to hire someone post 1 March, unfortunately, they're not going to be covered by JobKeeper. And if you have casuals, they have to have been with you for 12 months. So that's another key factor. But the idea is that you can get you get $1,500 per employee that is eligible under the JobKeeper per fortnight. So that's to help you pay their wages of up to $1,500 per fortnight. So the employee can still earn more than that. It's just that the business is getting a supplement for that wage to help keep as many employees employed. It also means that some employees who have had their hours cut completely or are stood down during this process can continue to receive $1,500 a fortnight, even though they may not be working. So that is an alternative for them being laid off completely and having to go apply for the job seeker rules through Centrelink. So this is allowing them to stay being paid as per normal through their employer, even though they might be currently stood down and not able to work because, maybe they work in a restaurant or some retail space that's not allowed to be open during this time.
And I guess from a business perspective as well, when it does pick up again, like, for example, restaurants, shops, factories, etc., that they will have a workforce ready rather than having to go out and look and recruit them. So there's the benefits there. And also with regards to tax on the JobKeeper allowance, how does that work?
Yeah. So the JobKeeper allowance is still taxed at normal tax rates. So people will still have tax coming out of it. It might be at a lower tax threshold than what their normal pay is because overall they're still being paid less. But it's at the standard PAYG withholding rates. And so it's important to note that you're not going to get the full $1,500. It will be $1,500 less tax during that time. Other things that I guess, most employers were really concerned about what they were doing with their employees during this time because on one hand, they're trying to keep the business afloat so that there is ongoing business, but they didn't want to have to let employees go if they didn't have to. So this has been really great that the government's come out with this and given them that bit of relief. And like you said, it means that those employees can come back. But one of the questions that we're getting is, do we have to have all of our employees on JobKeeper? And the answer is yes. It's a one in, all in. They do not want you cherry picking your staff. This is not a way for you to get around normal performance managing someone out of the business. So you can't just let someone go during this time. So one of the things I think people have underestimated during this whole process and these last few weeks is what their obligations are from a fair work perspective and that industrial relations perspective. So we are trying to encourage anyone who is thinking about whether they have to make staff redundant that they do go and seek advice around what's applicable in their particular business, especially given there was already some award changes earlier in the year. So the other thing that's coming up a lot is, can I just ask my staff to take a pay cut? And that's not able to happen. You can't just ask your staff to work the same hours but at a reduced rate. So just one of the things when you're looking at JobKeeper and looking at some of these rules is to understand your employment obligations.
Yes, yep. So it has to be a discussion as opposed to a mandate to your employees.
Yes, yeah. Other key things with JobKeeper to note is that it does require your employees to be engaged in this process. So they need to acknowledge that they'll be going on to JobKeeper and they need to confirm that they're not claiming JobKeeper from any other employer. So especially with casual staff in hospitality industry or retail industry, some like a lot of employees would have more than one place of employment. And so it's up to them to let the business know if they are receiving it somewhere else. So you as an employer need to check in with them and confirm that they're not getting it anywhere else.
And the ATO and the government generally are being, as I say, reasonably generous. However, I think if people start misleading and trying to take advantage of it, that the foot will be stomping down quite heavily. I would have thought.
Yeah. So there's lots of complications to this from a business owner perspective as well. And I'm seeing a few articles already about employees demanding to be put on JobKeeper from their employer. But there's things that an employer needs to check off before they can go and do this. So firstly is the business eligible? Have they had a 30% downturn in their revenue as compared to last year? So, and it has to be it has to be the same month last year. It's a comparable time frame or the same quarter. So if you didn't qualify for March, you could project out to see whether your revenue could be downturned more than 30% in April, or you could project out for the whole June quarter as to whether it's going to be. So if you know April's not going to be, but maybe May and June are going to be terrible, you still might meet it for the whole quarter, which means you should be still applying now for the quarterly basis, and that will enable you to get JobKeeper for April, May, June, and
so doing
onwards.
that whole quarter, April through till June.
Yeah. So another reason to know your numbers is you need to know how you've performed in these periods last year so you can do your comparisons. And you need to have a good feel for projections, because you can apply on projections and use those in your application process. But just be careful when you're doing that, because if your revenue doesn't fall as much as what was projected, you may be required to pay that back. The tax office has said they will give some leeway into that, as to, like, if you were maybe only 20%, 29% down, not 30%, they'd probably be okay. But we don't know exactly how much leeway they're planning on giving if you do happen to not fall by that 30%.
So honesty is obviously the best policy. And as I understand it, once you're in, but you still have to carry on reporting. So you're in until, I think, late September. Is that right?
That's one of the most generous things that we've seen about it, is that once you're in to the JobKeeper system and you're eligible, you can stay in until 30 September. So that's where they're proposed to end it. And I think that's great. I mean, that's recognizing that 30% downturn in revenue, even if it only happens to be for that 1 month, it's still a significant loss to a business. So they will leave you in that system to help the business recover right through till the 30 September.
And regardless of that, say, for example, you're considerably down on March and April, but then things get a bit better in July, August, and you're a bit higher than you were in that month the previous year, are you still in, or does that create problems?
You're still in the system. So once you're in, is the way it's all written. But the reporting requirements are there. So every month, the employer has to report their figures to the tax office. So that's within 7 days of an end of month. We haven't actually seen exactly what needs to be reported yet. We haven't seen those forms come through, or exactly how the tax office wants that reported. And we haven't exactly been told why they want that reported. So we assume initially it's to check what the downturn is. And there's probably definitely a bit of information gathering happening there. But what I would say is it's probably also for them to do a little bit of spot checking and targeting as to who they might want to look at first for more information, to make sure no one is actually manufacturing their figures. So we are telling people well and truly, do not try and artificially create a drop in income for this period. Great, if you're in, you're in. But if you can't get in, then you're going to have to hold off until you can. Don't try to manufacture it, because you will get caught out. And if you get caught out, you're expected to repay it.
So if your March and April figures, or even your quarter, April, May, June, the door isn't necessarily closed for the following few months afterwards, so you can still apply later on.
We don't know exactly when the applications drop off completely, but payments definitely go through till 30 September. but you can apply. So if you don't meet it for April, even on projected figures, you can apply in May, for example. Okay. Yeah.
So months moving forward to be revealed kind of thing.
Yeah, we're looking at it on a month-by-month basis. My understanding is you can do it, if you don't do April, you can apply in May, and we're expecting the same for June, but we're not sure after that.
So those are the two big ones for the government stimulus package. Is there anything else that you think businesses should be aware of and be thinking about?
Yeah, so some of the interesting ones that I think people may not have realised or may not have taken notice of is there's been a massive uplift in the instant asset write-off. So small to medium businesses have been able to write off certain assets under $20,000 rather than having to depreciate them. They can write them off in the first year. Now that's been extended upwards. So just confirming that amount. So it's increased actually. Sorry, it was currently $30,000 a year, and that's gone up to $150,000 in terms of an instant asset write-off. So normally, if you bought something, a piece of equipment for your business, and it was $100,000, you'd have to depreciate that over the life of the asset. Instead, you're going to be able to write that off as a tax deduction straight up. So that's a big boost for a business, because what that means is it brings that taxable income down and it pushes out any tax liabilities for them. So that's a good boost, and something, if a business has the cash flow to do those purchases, it's something that they should consider. Or if they have a piece of equipment that they need to buy, or equipment that's starting to wear out that they were planning on buying soon, and then now's the time to actually be thinking of that. There's also accelerated depreciation for the 2020 financial year and up to 30 June 2021 financial year. So that will help businesses write off assets that they already own at a faster rate and allow them to increase their tax deductions for those 2 financial years as well. So that's a good one. There's also, I guess, some allowances being made for businesses that are doing it tough. So they've relaxed some of the insolvency rules during this period, and that's meant that, if normally a creditor can chase after a business that hasn't paid them, and that debt is usually only like a $5,000 debt, but they've increased that. They have to have been owed more than $20,000 to sort of push that with the business and push that business into the insolvency provisions. And they're already relaxing some rules under insolvency as to the penalties a director's liable during this time. It will be interesting to see the knock-on effect of doing this, but the whole focus of this is to try and keep businesses moving who might technically look insolvent during this period, that can but have great potential to come back post the pandemic and post the lockdowns being removed.
Yes, which we will come out the other side of this, and hopefully in the best shape that we can do. And overall, is there any additional advice or thoughts that you'd like to provide for businesses at the current moment in time?
Yeah, I think what I'm seeing is a lot of opportunity has come out of this. So businesses are using the downtime to improve their resources that they might have. So maybe they're using it to develop their content ready for marketing when lockdown's removed. They're looking at new product lines. They're making changes to their business and reviewing costs in their business or underperforming product lines, I guess, which they probably should have been doing, but probably never had the time to really focus on before, and expanding into new product lines and new opportunities. It's just amazing to see how innovative Australian businesses have been during this time. So I would suggest, if you're in business, to start brainstorming with a trusted group of people as to what you could be doing while you've got some extra time on your hands, because I think small to medium business owners never have downtime. So during a time like this, when they've actually potentially got some extra time on their hands, is a time for them to sit back and reflect and to really forge out a bit of a new business plan and look at different alternatives and opportunities. Yeah.
Which is very much the way that I'm seeing it as a business owner at the moment. Although there are other people and businesses that are having it much tougher. And I guess from your advice earlier on in the conversation about managing that cash flow and cutting costs where needed, but we do have a time to think more strategically, which is quite refreshing, I find.
Yeah, one of the discussions that we've been having with a few people is a lot of them are considering whether they really need an office premise going forward. So many people have adapted to the work from home environment so well that they're not saying they won't ever have an office premises, but maybe a reduced size or a lot more of that office sharing or hot desking spaces will be used, which isn't great for landlords or some of my clients who own commercial properties inside their super. But it is something that people are considering is this is working well. So what can we do to keep it going in the future, and what can we offer staff to work from home? I know my team in particular, there's some team members who travel a long way to the office each day to work. They're choosing to spend that travel time doing a bit of extra work or to improve their, their overall life balance. And they're getting in exercise that they wouldn't normally have time to do. So, which is, overall improving their mindset, their health, and their focus when they are working. So I think it's a really good opportunity. It's sort of removed location barriers for a lot of businesses as well. So yeah, I think as a business owner, you really need to reflect as to what you've learnt through this process. And we've already got learnings. We're only about 4 weeks in. Imagine what we're going to have in a few months' time. So
yeah, you make a really good point that if you look at it from the positive angle about being at home and not being imprisoned in your home, so to speak, there are lots of benefits. Although it would be nice to get out and go to restaurants and see more people, but overall, I agree that remote working, flexibility, and obviously the impact on work-life balance, and also the environment as well with that lack of commute. Well, thank you very much, Megan. Is there anything else that you'd like to add at all?
I guess my only comment is one thing I didn't talk about with the JobKeeper is potentially the cash flow considerations for a business, because one of the things that people really need to understand is the business needs to have paid those employees before they get the JobKeeper payment to the business. So if the business doesn't have the cash already, they need to probably consider whether they can afford or talk to their finance brokers about if they can have an overdraft or increase an overdraft, if that means that it allows their business to get back to work. So just probably something that I had missed from that conversation and something that needs to be considered as part of those JobKeeper registrations. Yeah.
Yes, that's a really important point. Well, thank you very much for that added extra. And thank you. It's been a delight speaking to you. So thank you very much.
Yeah, thank you very much, Nicola. Thanks for having me.
I hope that you enjoyed this episode. Please remember to subscribe, rate, and review. If you're looking for career advice, your next career opportunity, or to grow your tech team, then please call me, Nicola Steele, on 0499 773 546, or go to our website, jjptalent.com.au. The Don't Just Survive, Thrive podcast is part of the Spotlight series, which includes the YouTube channel, Spotlight on Software Development. If you want more insights into the software industry, particularly tech startups, then subscribe to the Spotlight on Software Development YouTube channel. Thank you for listening. Until next time.